Hey, what's going on? Financially Fluent Friday. We've got Sarah Haliburton with the Beer Home team here with us. How you doing, Miss
Hello.
Sarah?
I'm great. How are you?
Doing well. Battling a little head cold, so if I sound a little raspy, please forgive me. But we're doing all right, making our way through the day, definitely. So
That's awesome. I know we're all battling it here as the weather changes, right?
yeah, that, and we had the nephews over this weekend, and they brought a little cold with them, and that was that. So I'm going to tag you on this post real quick, and then we'll get rocking and rolling here. Should be pretty quick.
Sounds good to me.
Perfect.
Got a lot to cover today, right, Zach?
Definitely do. Lots going on, obviously, and so we want to make sure we cover everything here. So let's just jump into it. I know one of the first things, every hot topic on everybody's mind right now is interest rates. Everybody wants to talk about rates because they are changing, they are going up, and it affects affordability. It affects what you can buy, but also what you're going to pay, whether it's your top end or just what you want to pay. And then also there's some questions about how does things happening internationally affect rates and all that. So let's just jump in. I mean, first thing, we're seeing rates are up. I mean, normally speaking, when you have international turmoil, things like that, you'd see kind of a dip in rates, but we're not seeing that. There's a lot of reasons probably why. I think inflation's the biggest thing, but they're up, and so it is impacting affordability. It is impacting payments, and for some people, it could impact whether or not they qualify for what they qualify for, and whether or not they're going to be priced out. And I think that's an important thing to talk about. Obviously, in a hot market like this, in such a competitive market where we have a low inventory, whether or not you qualify is a big question, and having that what you qualify for get kind of wiped out from under you, especially while you're searching, is a real risk if you wait too long. So why don't we talk about that a little bit? And do you have any insight on that end as far as what you qualify for or where you're at? Hey, what's going on, Luke? Good to see you,
Uh,
brother.
I do a little bit. So there's different things that we look at, right? And obviously inflation plays a part because we don't want to be house rich and cash poor. We don't want to go in and spend our absolute max and then not have money to live our life. So your job as a lender, my job as a realtor is to kind of match the two and give people a realistic expectation of what they can pay monthly and what they want to pay. Now, Zach, I know that something that's super important for me when I'm working with clients is that once we get something accepted, we lock immediately. And if rates go down, then we'll relock, right? But we always want to lock immediately because we can't control outside factors. And so that's something that's very important to us. The other thing, too, is like being super upfront with our lenders and letting them know every single piece of information. But when it comes to the rates themselves, we have to put it in perspective of, yes, rates have gone up. They don't have a two in front of them anymore, but they're not where they were in the 80s, 90s, or even the early 2000s when they were 7, 8, 12%. So they're still historically low. This is like 2019 rates to me. Because when I bought my house, our rate was 5%. We bought it down a little bit to 4.6, and we were able to do that with some lender credits and things like that. And so to me, this is very normal. This is not high rates.
Yeah. Yeah, I think we kind of got spoiled a little bit when we had the rates go as crazy low as they did. I think, and it kind of got this taste in people's mouth where they heard all their friends and all their family talking about, oh, I got in the twos and low threes, and honestly, they were great. I loved it doing it. Obviously, the refi boom was nice. It was nice helping people get really, really low. Yes, you see Tony. One of my friend Luke's here. He sees Tony Gwynn behind me. Yes, you know it. But yeah, no, and that's absolutely the case. The thing is that I think we were talking about this ahead of time. We got on a call this morning talking about this video. Money's still on sale. Money is still cheap. You're not going to find a lower source of cash. Bottom line, and realistically, we've said this more than once. My parents had a 12% rate, a variable adjustable rate, on one of those crazy interest only loans that ended up costing them at the end of the day. And they were doing the refi rollover, but we're still seeing rates that are ridiculously low. And I've seen these rates. I've been in the business long enough to have seen these rates before. And maybe there will come a time where we can refi down again and we'll see that boom. But don't cost yourself the opportunity to get into the home and to get that start building that equity, have that asset, have the tax write-off, be in control where you're not paying somebody else's mortgage. I mean, the other thing to think about, and I keep harping on this, is that rents have gone up 13%, almost 13%, right?
Well,
So,
and Zach, rates are 100% interest, right? Like we're not building anything. We're not moving towards, we're moving towards a moving target that's not ours. We're paying off somebody else's mortgage, and we're doing those things. So while rates have ticked up a little bit to 5%, we're not getting any benefit from renting at all.
Yeah, and I think part of that comes down to being in communication, regular communication on my side and your side with the clients. Are they watching the market? Are they being aggressive? I think that, we've seen some different posts about, why do you want to come in over on a property? And realistically, if you have that, you have that change in rate, yeah, it'll cost your payment a little bit. But if the house goes up by $100,000 in 2 months that you were looking for, guess what? That's a heck of a lot different in your monthly payment. Yeah, somebody made a good point. Buying a home hedges against inflation. One of the absolute best places to have your money when in a time of inflation is in real property, in real estate. And most people who have assets and have the money, they're buying as much real estate as possible right now because they know better. And generally speaking, people that have built that at the time and built up some portfolios, they understand that, the markets right now, yeah, you can, if you're savvy and you want to play day trader, okay, great. But there's a lot of risk there. But you buy a home, you buy real property, it's going to protect you bottom line because the homes retain that value just hands down.
Zach, we always talk about this too, and I know that we've mentioned this before, but follow the money. Wall Street has 18% of their portfolio in real estate. There's a reason they're buying and holding property faster than we can, and so there's something to be said there. And if you look historically over time, yeah, you've got blips in the market, but over time, real estate's always been the most solid investment. And we're starting to see people that had money in stocks and crypto, those markets are starting to shift a little bit, especially with what's going on globally. And so I think a lot of that shift is people pulling money out of unsecure markets and putting it into real estate, which is where they know long-term gain will be.
Yeah, absolutely. Absolutely. And I think that it's all relative. First, of course, talk about the payment. We've talked about that before. You don't want to be house poor. Make sure that the home, your budget's, it's within your budget and you can go ahead, afford to live your life, do things with your family, travel, do whatever it is you feel, you're used to doing. But also realize that it's going to be a little bit more expensive to own a house up front than it is to potentially rent a house. But there's so much more return on the long end. And there's a reason why they talk about building generational wealth, building assets for your family, building up a home that, you have equity. If you needed to make a move, you have, we're doing the math on it. We have over $400,000 in equity in our home right now if we were to walk away from here, for any reason. So, maybe if we needed to expand the home, if when your family grows, you need to step up, get into a position now where you're starting to build that equity so that you can use it later on down the line.
Buy a second property in a different state. Like, you have so many options when you own the asset. When somebody else owns the asset, you have zero options. And I think that that's what you and I are really in alignment with, is providing people options to leverage other people's money to create generational wealth. That's how the rich stay rich.
Go ahead.
And I was going to touch on this, and I know that we kind of briefly talked about it this morning, but with the way the pricing is going, we're also seeing people going into the outlying cities of San Diego, right? Yep. And looking for other opportunities. And I posted something the other day that had how many, the top 16 cities or whatever, and I think La Mesa came in 16 most expensive, but we're seeing huge increases in Bonsall, Fallbrook, Alpine, these outlying areas, because people are moving to where it's affordable.
Yeah. I actually, and I had a client that she's a nurse. She works out here at Grossmont in La Mesa. And when she lived in La Mesa, but when she bought, she ended up buying in Campo, and she was able to get a house for under $500,000. And this was just not too long ago. I mean, it was a beautiful house. It was a gorgeous house, big enough for her family, and had a yard. The whole thing was a beautiful home. It was in Campo, so it's a bit of a ride. But you know what? She understands that she wants to get in there and invest in property. She was looking at condos before. She actually, I saved her loan from another lender. Another lender had dropped the ball on her without going into it. And when I showed her what we could do, and I showed her she could qualify for higher, and she could qualify for a house, she started looking, and she realized really quickly that the only place she was going to be able to afford a home was not quite in the city, not in La Mesa where she was. And she got out, she bought the home, and you know what? That home's already jumped up almost $100,000 in value since when we finished that transaction. So that's massive. So she's already built massive amount of equity. She actually used the down payment assistance program. She was a great candidate for it. So she's doubly using other people's money. And when the time comes, she can either if the rate somebody's calling in there. Should have put no, do not disturb. But when the time comes, she could also sell that home and walk away with a massive gain there. So it's just huge. So open the doors a little bit. Be a little bit more open to getting outside of that heart of the city, unless you have the budget. And, reality of budget's the crunch right now, and the rate's the issue. Open your scope a little bit. You have to be open to different opportunity. Have you, I know we were talking a little bit about building and talking about buying land. I know you've had an experience recently, kind of shared some insight. What's your thoughts on maybe buying land and owning land and building homes on it and building a home?
So number one, San Diego's at a crunch anyways. And this is why pricing and why we don't feel that there's going to be a crash here is because we can't expand, right? We can't go east, it's the mountains. We can't go north, it's LA. We can't go west, it's the ocean. And we can't go south, it's Mexico. So San Diego's got a really, really tight area where we can actually build more housing. And that's why this scenario is a little bit different than the crash in 2008. Back then, we had so many builders and we had so much inventory that was coming to market. We have no building going on right now, very, very limited. And with COVID, everything's even more behind. But the other problem to that is finding the land. So I was with some clients, we were able to find a couple parcels of land that actually looked to be a good opportunity. They were in Valley Center, again, an outlying area. And the cost of building really comes into where are the utilities, how can we get the utilities in, the types of loan programs. You got to do a land loan or you got to do land and construction. You got to have some money down. Land and construction is a very timely process. Some programs require you got permits. Permits are 9 months behind. So there's a lot of complicated factors that go into this. And then it's, what are you going to build? Are you going to build a stick-built house? Are you going to build a modular home? Some don't allow for modular homes. So there's a lot of different things. But when it came down to it, and we finally got the offer accepted, we were almost there to get the land. They go, well, the interest rate's 5%. I can't spend that. It's too expensive. And I said, well, is it unaffordable, or is it just the mindset of rates were 2% and now they're 5? Well, rates were 2 and now they're 5. So are we advancing, or what are you going to do? What's your plan? What's your backup? So you're going to rent. Okay, well, where's that going to lead you? So those are the types of conversations that we're having, because people do feel like the pricing and the rates are so high, but at the same time, we know that waiting isn't the answer.
Well, yeah, because rates at this point, we have no indication they're going to drop, and they have to battle inflation, just bottom line. And we're continuing to see that every single day in every aspect of life. And another thing that tags onto that, you mentioned permits are 9 months out. What do you think inflation is going to do to the cost of the build? Because realistically, they're going to get you bids on stuff, but they can't necessarily guarantee that. I having done a ton of home improvement recently, I saw the cost jump insane amount. I mean, we did the back patio. It went up about $5,000, or no, probably about $7,000 actually to do the back patio. The concrete work we did went up over $5,000 over the course of when we initially quoted it. I mean, the cost of building gets more expensive as well. So, that the opportunity cost is very, very much different there. And the other side of the coin, if you think about it, you know what? An interest rate right now with great credit still in the 4%, low fours, but still around 4%. And that's not a huge difference if you're getting to build your dream and you're getting the land and you're getting the space and you're actually getting to do, get where you want to be and get a big, beautiful home. And so that's something to think about as well.
Well, and I think it's the opportunity too. Like, this one was very specific because there was another lot for sale. There was another buyer that was already in escrow. He'd already done 90% of the legwork on getting the utilities and figuring all that out, and already paying for all of those reports. And then they could actually split the cost of bringing in the utilities. So those types of opportunities are the ones I'm like, hey, don't pass this up over a 5% interest rate. Now, if it was a different story where it was going to cost way more to bring in utilities, you had no one around, and it was going to be very complicated, that might be a different story. But all because of the mindset of, well, rates are too high is a little bit disheartening, I think, when you can see the opportunity ahead of them and you want to tell them, like, rent's 100% interest, and what's your plan after that? Because pricing, from what we've seen, isn't going to go down anytime soon.
Yeah, that's it. I mean, you nailed it. I think we could go on and on about that, but that's 100% the point. And you said it more than once today. Rent is 100% interest. Bottom line, there's no tax benefit. You have zero control. Realistically, they can raise the rents on you when you get your mortgage fixed in. It's not going to change. I mean, there's so many different points. So you're right. So let's shift gears a little bit here. I want to talk about something that's near and dear to my heart and that's really important. And it has to do with telling your lender everything. The thing is, and what people don't understand, I always tell my clients when I talk with them, you're not going to have much more of a more intimate conversation with anybody besides your partner, besides your husband, your wife, your boyfriend, girlfriend. You're not going to get more intimate than you will with your lender initially, because your lender is going to get into everything. I need to know the financials. I need to know the nitty gritty. I need to know about debt. I need to know about, bad history too. I need to know all of it. And so, you have to be very, very forthcoming. And there's the other things you have to think about, because depending on the loan program, we're in a community property state. And if, we need to know about your marital status. And so you told me a story this morning that I think is really poignant, really important. And so I wanted you to kind of share that story here and kind of fill in the
Yeah.
gap in this.
These things happen, right? So, we're out looking at homes, we're going through the battlefields, we find the right home, finally get our offer accepted, we get all the way to the finish line, we negotiate the repairs, we do everything. We're 4 days out from closing. There's a conditional loan approval, and one of the conditions is, well, Mr. Borrower, we need the divorce decree from 12 years ago. Well, what do you mean? I don't have one. We filed, but we never signed this paper. So all of a sudden, now we have an estranged spouse in the mix. Well, we're using an FHA loan, which means that spouse's credit needs to be run, their debt needs to be run, even if they're not on the loan. So this is causing a lot of turmoil for my borrower and his new fiance, who are looking forward to this dream home that they're 4 days away from. So and this has happened to me before, Zach, actually with another client. We were 2 days out from closing, and all of a sudden an old short sale from the borrower's fiance comes up that was 6 years and 52 days, so we're right on the cusp. But we were never told about these things. And so it can really delay your process, and all of the work that you've done and all of the excitement and everything that you're looking forward to can come crashing down if you're not super forthcoming with your financial picture, because there are ways that we could have worked around it. There's things that we could have done, other programs that we could have tried. And so I think from this side, it's super, super important to be very transparent.
It's important to know that, bottom line, if you're doing a government loan, whether it's an FHA, VA, USDA, any government-backed loan, and you're in a community property state, we need to know about spouses. We need to know whether if you're divorced, one thing, single, and here's the thing, you can't hide that stuff. It always ends up coming up in the wash. There's always something that ends up tagging back. And I've seen this happen more than once as well. The only way that you get around that is with a conventional loan. That's the only time that they're not going to look at it. But if you're doing any type of government loan, you have to be forthcoming. And that's bankruptcies, that's foreclosures, that's short sales, that's marriage, divorce, separation. They dig in. Underwriters, their job is to get in and chip away at all the cracks to find the kernel, if you will. And so just remember that if you're out there shopping and you're using a government loan, and any loan you're using, honestly, just be sure that you're. And I know in your situation, we talked about it. Your lender actually asked about it, and they, maybe this buyer didn't recognize that, they needed that they needed to be forthcoming that the divorce wasn't done. And maybe, but it's so important. I think we just needed to touch on that. And don't leave anything out. We need to know all of it. Just, I don't, even if you think it's insignificant, tell me and let me decide that it's insignificant. I'll put it to the side. I'll tell you, we don't have to worry about it, but don't leave me scrambling 2 days before we're supposed to be closing to get a conditional approval. Oh, by the way, we need your divorce decree.
Well, yeah, I mean, luckily, and typically this is not the way it goes, but luckily we've dragged our feet on removing some of our contingencies. So we still have a couple safety nets in place, but typically that would not be the case. And his $15,000 deposit would have been up for grabs to the seller. So it's super, super important just to be on the same page with everybody and disclose everything up front.
Definitely. Well, I appreciate it. That's so true. So, well, Sarah, awesome stuff. I really appreciate you taking the time for me today. Have a great weekend. I know you've been really busy lately. You've got a couple of escrows going and just killing the game, huh?
Yeah, working on it, getting people their dreams. So
that's good.
That's it. Well, thanks for your time today. I really appreciate it.
Awesome. We'll see you next Friday, and make it a great day. Have a great day, everybody.